That would take bank shares to zero. Again, that's not going to happen overnight, but that's coming. And a crash in China leads to a crash in the United States. Yes, that's very possible. Bitcoin will not replace the dollar, but it may destroy the idea of money. It's really important to sort out, because I make forecasts all the time, and I'll make a forecast, and the next day, the opposite will happen, and somebody go, "Well, you're a dope. You did wrong." No, you have to look at short-term, intermediate-term, long-term forecasts. I just gave you a goal forecast, but I specified 4 to 5 years. Most of my forecasts are 6 months, but they're constantly updated. So, but here's the threat to bank shares, not just banks, but also MasterCard and Visa. They could be completely disintermediated and driven out of business by central bank digital currencies. I mean, what's being envisioned right now is, and the Fed is a little behind the curve. China's got a prototype. They're going to really promote it during the Winter Olympics next year. Europe is working on it. The Fed's working on it. They'll probably have something in the next 2 years, but it will get to the point where you'll have an account at the Fed and your dollars will be on a smart card or your smartphone. And when you want to pay somebody else, it'll go right through the Fed ledger. You don't need a bank. Why do you need deposit slips and online banking and withdrawals and all, balance? Why do you need all that? You don't need any of that. Why do you need MasterCard and Visa? You can just have a digital dollar account at the Fed. So that is that would take bank shares to zero. Again, that's not going to happen overnight, but that's coming, and investors are usually the last to know. Stock market's supposed to be forward looking. They don't do a very good job, but they look forward, but they usually get it wrong. So here's a case where if you don't understand that central bank digital currencies can disintermediate the entire banking system, that's important that you do grasp that, because that would be fatal for bank shares, MasterCard and Visa.
Well, this is a big comment you're making. I love it. This is breaking news. You're saying that the central bank could lead us to Visa, MasterCard. We won't have one anymore. Go on.
Right, because Visa merchant acquirers charge about 2.5%.
Yeah.
Your bank charges you something, may not be a lot, but there are a lot of fees. It's slow, it's clunky, but we have to have it today because we need to pay for things. But if you have central bank digital currencies, and by the way, those are not cryptocurrencies. Central bank digital currencies are not cryptocurrencies. It's still going to be an Aussie dollar, or US dollar, or Japanese yen. It's just going to be in digital form. The message traffic is encrypted, but the ledger is run by the central bank. So who needs a bank?
This is big. All right, thank you, Jim. We're going to talk more about that, and when I get you back again, that's for sure. China will lead the bust, will lead the way to the next crash. Do you believe that?
The world economy, look, there are all different countries, all different political systems, all different economies. I understand all that. I spend virtually all my waking hours studying it, and I probably dream about it a little bit too. But the point is, so nothing is unlinked from everything else. But China is heading for a fall. I do agree with that. I just explained in my main presentation why U.S. stocks are in a bubble. And so when you're in a bubble, you say, well, okay, what's going to burst the bubble? What's going to change the narrative? What's going to change how people value stocks? Well, it can change internally just because the facts contradict the narrative, and at some point it becomes impossible to ignore it. But there can also be an exogenous shock. So could you have a shock where a crash in China leads to a crash in the United States? Yes, that's very possible. And China they have not successfully generated consumer economy. They're dependent on exports. Export markets are moving away. To me, the future is in places like Vietnam and India. They're going to be the main beneficiaries of the slowdown in China. U.S. is very rapidly moving its supply chain out of China as fast as we can. Americans like to talk endlessly about the difference between Donald Trump and Joe Biden. Okay, there are some differences, but there's one big area where there are no differences. The Biden administration is continuing the China policies of the Trump administration. Biden has not relieved those tariffs. They have not eased up on Chinese investment in the United States. They have not eased up on Chinese students coming to the United States. China is it's officially, it's atheistic. They have slavery, genocide, atheism, communism. It's like a trifecta. They support their economy with investment, over half of which is wasted, and they do that with debt, and it's utterly corrupt. So nothing's going to happen in the next 30 days because they got to get this anniversary, or 60 days rather. They got to get this anniversary party over for the 100th anniversary of the foundation of the Communist Party of China. But after that, later this year into next year, at a minimum, you'll see a Chinese slowdown. I think that's already baked in the pie. But the question is, does a Chinese slowdown lead to a Chinese crash? And the answer is it might. And if it does, a US crash could be right behind it because the US stock market is equally vulnerable because it's in the bubble.
The investment legend, Michael Burry, has come out with new predictions. And it's written in this article over the weekend in the Barefoot Investor, who you won't know who he is, but he's well known here in Australia. Mm-hmm. And the first thing that he said, the experiment of printing money is going to lead to hyperinflation and an economic catastrophe worldwide. What are your thoughts? Now, of course, he's saying hyperinflation. You're not saying that.
Not yet. Again, I would distinguish between 2024 and 2021, but let's just take those numbers. First of all, money printing by itself has nothing to do with inflation. Money printing does not cause inflation. What causes inflation is velocity, the turnover of money. So let's talk about velocity. Velocity is behavioral. It's psychological. It's something the central bank can't control, and it runs on a narrative. And so right now, there are inflationary expectations, but there's not actually any inflation. It's just not showing up in the data. People are saving. Savings rates are sky high. Savings rates, and this is slowing the economy down because if I make $1, I can spend it or save it, right? Well, the savings rates for 20 years have been averaging between 5 and 8%, with a central tendency around 7%. In the second quarter of 2020, they went up to 33%. Even as late as last summer, the savings rate was over 20%. Then it came down to 13% last November. And I looked at it and said, well, interesting. It went up to 33%. I was chugging up, and then it came down to 13%. Does that mean it's going to drop back down into that central tendency of around 7? No, it actually went back up. It's back up over 20. So these are historically sky-high savings rates in the United States, but that means people are not spending the money. There's very good data that shows, these government handout checks, every American, they got $600 at the end of last year. They got $1,400 the first week of March. And everyone said, this is going to stimulate the economy. No, the data is very clear. The data shows that 75% of the government handouts are either being saved or used to pay down debt, which economically is the same thing. When I pay down debt, that's not new consumption. I'm just paying off the consumption that already happened, last year or the year before. So it's all going into savings and debt reduction, which is a form of deleveraging. So there's no inflation on the horizon. So here's the question for monetary economics. The money's there. It's like dry wood, but you need a match. The match is velocity, which is a change in psychology. What's going to cause that? Now here, just to tie it all up with a bow, going back to what I said about in the keynote about how Bitcoin will not replace the dollar, but it may destroy the idea of money. And this is the real danger of Bitcoin. I don't care if the price goes to 100,000 or 10,000. I don't own any. I'm not going to buy any. And as I say, if you want something, knock yourself out. That's irrelevant. That's content. It's like you're missing the bigger picture. The bigger picture is we are immersed in an electronic environment created by Bitcoin, which destroys the notion of money the same way a urinal destroyed the notion of art. And if you do that, you may lose confidence in all forms of money, and then you get the hyperinflation.